sees what we can't.
Listen, babe. Listen, babe. Listen, babe. Listen, babe. Listen, babe. Listen, babe. Yes. Listen, babe. Listen, babe. Listen, babe. Yes. Listen, babe. Listen, babe. Listen, babe. Yes.
Okay, folks, we are looking at the intermediate term trading plan example. Now, what we're going to cover in this module is going to be just an example, like it states here. There's going to be certain aspects of this particular example of a plan where I can suggest that you could use other tools or applications, and where I note those, obviously, you can use the suggested mediums and tools at that time. It's not meant for you to use this as a specific trading plan. I'm not advocating that you take this and run with it, try to invest real money with it. It's meant to stimulate prudent decision making on your part, uh, determine whether or not you have the patience and faculties really to be a trader and follow a plan of this nature. And obviously, if we're talking about intermediate term trading, the duration of the trade is absolutely different than what most folks are doing in terms of Forex. By that means I'm referring to intraday and scalp trading. This is not very short-term trading. It's higher time frame premise predominantly, and your trades are going to take a whole lot of time to set up, and also equally more time to unfold to its completion. So this module will more or less demand a level of patience that probably the majority of traders will not have at the early stages of their development. All right, we're going to talk about the general market and the overall trading plan outline for trading intermediate term. Obviously, the time frame that we're going to be trading is the daily chart. Okay, the trading plan outline. Now, the time frame that we are trading in this specific example is going to be referred to predominantly the daily chart. And its primary focus in this plan is to trade the intermediate term price swings found on the daily chart. Typically, trade durations will last anywhere between several weeks to as many as months. Now, in this plan, we're going to classify bullish conditions and bearish conditions. Okay, and this is more or less the market environment that will facilitate buys and sells. First, we're obviously going to look at the bullish conditions. And typically, when you enter a seasonal tendency, when you would expect a bullish market, obviously that sets you on alert to look for turns or buying conditions in the marketplace that would facilitate long positions. We're going to be watching the interest rates, okay, and we want to be expecting interest rates to be moving higher and or looking for divergence, okay, in the yields to possibly indicate that we're bottoming out in the yields and we may be going higher. Because markets basically seek higher yields, that is going to create the risk on effect that we're looking for a bullish condition. Obviously, it goes without saying, if we're looking for a risk-on scenario, the US dollar is going to weaken at this time frame. So we're going to be looking for topping formations or uh, weakening of the US dollar on the daily chart. The Treasury notes, okay, 2-year, 5-year, and 10-year, we'll be looking for those futures markets because you are going to be contrasting Forex trading with the insights that we glean from the futures market. The daily charts on 2, 5, and 10-year should be declining, and because there's an inversion of relationship between the yields and the futures markets, um, T-notes will be going down on your daily charts, while that indicates that the interest rate itself, its yield, would be moving higher. COT, this commodity um, tool that we use, commitment of traders, we're going to be looking for hopefully the commercials being a net long position, or if they are net short, we want to be looking for an aggressively lessening of their short positions. Okay, and you can see that in open interest. Sentiment, obviously, on the daily chart should be oversold, and the way we're going to be determining that is we're going to be looking at a daily Williams percent R. Okay, so that's going to be our tool to more or less indicate to us whether or not if the market sentiment is oversold or overbought. Okay, in this case, since we're looking for bullish conditions, ideally the sentiment should be oversold. Stock indices, hopefully at this time, are firming and or bullish. Okay, so in other words, you're going to be looking for some kind of failure swing between the major stock indices, and that would be at hopefully at a key support level. Commodities should be at this time bullish, and we would reference that would be to look at the CRB index, and it should be trading firm to bullish at a key support level, and maybe even looking for a buy pattern of some sort, maybe the optimal trade entry, something of that nature. When I say firm, it means indicating an unwillingness to go lower. Okay, and gold and oil, obviously, good benchmarks for the economy. They should be firm and or to bullish as well. Conversely, obviously, for the bearish conditions, seasonally speaking, there should be a bearish market environment. Seasonally speaking, that should set you on alert to look for sell scenarios. Interest rates at this time should be moving lower, okay, because the market will shun lower yields. If the interest rates are dropping, that will indicate that there's a risk-off scenario. And if there's a risk-off scenario, it goes without saying that the US dollar would be strengthening at that time. Treasury notes on the daily chart should be rising, and again, because there's an inverted relationship between yield and the futures market, the interest rates yield will be moving lower, while the futures daily charts on the 2-year, 5-year, and 10-year should be rising. Commitment of traders report, the net positions should show commercials net short and or aggressively increasing short positions, and you find that with the referencing of the open interest. Sentiment should be overbought, and again, it's based on a Williams percent R basis on a daily chart, and we'll talk more about that when we start going into the actual analysis. And obviously the stock indices should be soft or to bearish on the daily chart, so your NASDAQ, Dow, and S&P indices should be topping in here and or trading at key resistance levels respectively. Commodities at this point should be bearish, and we would be referencing the CRB index again as well, hopefully looking for some kind of topping formation, key resistance levels, or some rejections at the highs, indicating that it is now soft and or trading bearishly. And again, referencing the gold and oil benchmarks for the economy should be soft, maybe resistance in both those markets as well, seeing softer prices and maybe to as much as bearishness to facilitate further confidence in a bearish market condition. Okay, the anticipatory stage for this example plan. Obviously, we always begin with identifying the higher time frame, monthly, weekly, and daily key support and resistance levels, because those levels are going to be the catalyst for us looking for signals. So without these levels, okay, we're not going to be taking a trade. So we must have a higher time frame, monthly, weekly, or daily key support and resistance level to facilitate a trade. Okay, so we're going to be waiting for these levels to be traded to. Now, while we're waiting for a setup, okay, when we're seasonally speaking bullish, okay, you're going to be stalking the yields, okay, the yield triads, and I'm going to refer to basically my favorite pairs for this plan, that being the fiber Euro USD and the cable British Pound USD pairs, okay, because they are crossed with the dollar. If we're seasonally speaking bullish, okay, what we're going to be looking for is the yields, okay, 5-year, 10-year, and 2-year. Between those three interest rate yields, if one fails to make a lower low, okay, that's going to be a positive divergence, indicating there's a possible turn in yields, and that may indicate a possible increase in yields, which would cause a bullishness and a risk on scenario. Okay, if we are seasonally speaking bearish, okay, and we see the yields between the US, the German, and the UK countries, yields fail to make equal highs in their yields, okay, that's a yield triad divergence. Okay, and we'll talk about that and we'll show examples if it's not very clear to you here, but that would indicate a bearish stage in the marketplace overall. So we're anticipating that to unfold. Okay, at the same time, we would obviously be hunting the same scenario with the US dollar index. Okay, we would be looking for the lows in the US dollar index versus the highs in the cross currencies. Okay, and again, we're looking at the euro versus the dollar and the British pound versus the dollar. So if we're making lower lows in the dollar but failing to make higher highs in one and or the both fiber and cable, then that is a USDX SMT divergence. Okay, and that would be bearish for the euro and or cable if the dollar was making lower lows and the euro or fiber, I'm sorry, yeah, euro or cable was unwilling to go higher. That's weakness. They should be confirmation between the three. If the dollar makes lower lows, that should be seen with higher highs with the fiber and cable. If there's not, there's a crack in correlation that may indicate something. Monitoring highs in the US dollar index versus the lows in the cross currency pairs, okay, fiber and cable. If we see higher highs in the dollar and a failure to go lower in the fiber or cable, again, that's an SMT divergence for the US dollar index. And that may be a crack in correlation that may indicate something. Now, this can also reverse itself. If you see higher highs in the euro or cable, but a failure to go lower on the lows on the dollar index, that is the same scenario. That is bullish for the dollar, which would indicate bearishness for the euro or cable. And again, this has to happen at a key resistance level for it to be bearish for the cross currency. Okay, the dollar index may be trading down to a support level and make a higher low when the cable and fiber maybe made a higher high. It looks bullish on their charts, but behind the scenes you can see that there's actually strengthening going on at a key support level for the dollar index. And again, same thing happens if you reverse it. If the US dollar index fails to make a higher high, while the lower lows that are seen in the cable or fiber are met equally. In other words, there's lower lows in the cross-currency euro or cable. There's a cracking correlation as well. So you have to compare the highs and lows between the three, okay, and that'll also segue into the correlated pair SMT. You're going to be looking for the lows between the pound and the euro. Okay, so though generally they move in tandem, if we see trading at a key support level and one fails to make a lower low, that's a correlated pair SMT divergence, possibly indicating there should be a short-term shift in the marketplace for a bounce higher. And obviously comparing the highs at key resistance levels, if the pound and euro fail to make equal highs, that's a correlated pair SMT, possibly indicating some distribution in the marketplace, and there may be a short-term shift in the marketplace lower. We'll be watching the stock market indices, okay, looking for SMT divergences as well. looking for the Dow, S&P 500, and NASDAQ Composite Index to comparably make higher highs and lower lows. If we're bullish and we're in a bullish environment and we see the Dow, S&P 500, and NASDAQ trading lower in tandem, and eventually one fails to make that lower low at a key support level at a time frame when everything else is lining up, that is a stock market Smt divergence. Okay, so we want to be seeing confirmation. We want to be measuring on a daily basis, monitoring the overall risk on and risk off scenario. So using Dow theory, essentially, we want to be looking for these three averages to confirm higher highs for continuation on the upside, and or looking for continuation and confirmation between the three as they go lower. There should be lower lows between the three. If one starts to buck that trend at a key resistance or support level, there's an indication that you may have to pay closer attention, because there may be something setting up, or if you're in a trade, it may be indicating it's time to tighten up some stop losses and take some profits, or even exit the trade. Again, referring to the commitment trader's net position, we're going to be looking for long positions when the commercials are net long, and obviously looking for shorts when the commercials are net short. Looking at the overall trend of where the commercials are trading on the weekly charts using the commitment trader's net position, you'll be able to see where they're trading in terms of a long-term macro trend, and we're going to be getting in sync with that using the COT and higher time frame key support resistance levels. Open interest, we've discussed this in other modules, and obviously we're not going to beat it to death here, but basically it's when we're in a bullish condition and we're trading at support. If we see a 15 to 20% drop in open interest, that is a very, very strong indication that a buy signal is either forming and or it has formed, and it's bullish. In bearish conditions, when price is trading at resistance and we see a increase in open interest 15 to 20% or more, it doesn't have to be just 20%. It may many times be even greater than that in terms of an increase, but you want to see it rapidly increase, and you don't want to see a gradual increase. You want to see a rapid increase, and just as well as you want to see an increase when it drops for bullishness, you want to see it rapidly do that, because that's an indication that the commercials are really, really adjusting positions and allocating funds to offset the initial risk or risk on scenario that may impact the market they're actually working within. So if you see an increase in open interest at a resistance level, that's bearish. Market sentiment, obviously we would be expecting sell signals when we are at key resistance levels and overbought based on the daily chart. And we would be looking for buy signals when we're at key support and oversold on the daily. All right, the execution stage, obviously, again, referencing the monthly, weekly, and daily key support and resistance levels. We're going to be determining, before we do any trades at all, we're going to be determining that specific moment. Are we on risk or off risk for that particular day or that session that we're trading? If we are risk on, obviously, your buy scenarios are a go. If we are risk off, your sell scenarios are a go. You want to be referring to the daily buy and sell programs. Okay, and that means, are we trading off of a key support and off a swing point formation on the daily chart? Because that's what you need for buys. And if we are in a sell program and we see a swing high forming at a key resistance level, okay, that's an indication that we are in fact a go for risk off scenario and daily sell program. Okay, so that has to happen for us to be confident with our trading for this style of trading. When we have that scenario in effect, you're going to be transposing those key levels from the higher time frame monthly, weekly, and daily down to your lower time frame 60-minute, 15-minute, and 5-minute charts. You're going to wait for price to trade to those higher time frame key support and resistance levels. You want to only be trading in the direction of the market structure that you find that's on the daily chart. So your market structure is going to be daily basis. Okay, you're not looking at market flow on 1-hour charts, 4-hour charts. You're only trading in the direction of the market structure that you find on the daily chart. You're using optimal trade entry. Now, this point here, you can use any trading pattern of your choice. If you like the reflection pattern, you can trade that. If you like MACD divergence, this is what you would use here. If you are type 1 bearish divergence for stochastics, that's the pattern you would use here. If you like turtle soup patterns, that's the pattern you would use here. Okay, but you have to trade it at a lower time frame at a key support resistance level in the direction of the market structure on the daily chart. Okay, so the plug and play aspect here is you can use any entry pattern that you want, but it has to be in conjunction with the things that we've already discussed so far. Okay, entry ideally should be traded in a major session open. Obviously I don't have it here. Asia could be one. um, London and New York open are good because they're just good times to be trading higher time frame setups for the fiber and cable. But if you're a yen pair trader, or if you're an Aussie trader, or a Kiwi trader or something like that, you could trade your positions in the Asian session opening, okay, because those currencies have a lot of activity during those times of day. So if you are a Aussie, Kiwi, or yen trader, obviously the Asian session would be a session that you could be utilizing for higher time frame intermediate term trades as well for entry. Our entry orders are going to be based on limit orders, and we'll be keying off of the 62, 70.5, and 79% retracement levels on the fibs to arrive at our entry points. And every one of our trades will always have a maximum risk of 2%, never more. And ideally, less. If we take a loss, we reduce the risk as we go through. If you don't know what I'm referring to, go to our video for handling losses, and it gives you a program how to apply risk reduction procedures in terms of how to preserve your equity. And it's always good to have that, not always walking in the marketplace looking for exponential growth of your equity. You always have to have a shield, and you're going to have losses. You're going to have a string of losses. So this example is not exempt from that. You will have losses if you use this. Okay, and again, I'm stressing this. Use this in a demo account. Okay, you determine if you have the capabilities to be a trader using this as a model. Okay, it will help develop patience. It'll help develop anticipatory skills as a trader, but you won't have a whole lot of trades. Okay, but it teaches you the concepts and the processes that's needed, because if you can understand how to do this, all the aspects of trading on a short-term basis, short-term trading, day trading, scalping, if that's what you want to do, those facets of trading will be far easier if you understand this higher time frame premise where you have that major tide in your favor. Okay, it's kind of like a fish. Okay, if you're a fish in a stream, okay, what's easier, if you swim downstream with the current, or if you swim upstream? Okay, obviously it goes without saying it's easier to swim downstream. There's a fish, it's a salmon. It's one of the strongest fish in nature. It actually swims up current, okay, and leaps up out of the water and scales over rocks and everything. And a lot of folks that know that will say, I can be like that salmon. Okay, I'm going to swim against the current, and I can prove how strong I am, and I'll be a contrarian trader every single time, and never try to worry about getting in sync with the overall tide. And that's fine. Okay, granted, you'll probably get to where you're going, but if you're using the salmon as an example, you might want to recall also, when the salmon gets to where it's got to go to fertilize those eggs, it dies. So I mean, it's good that you get there, but if you're exhausted and you croak, what good is that? So you want to be having things majority in your favor and trading with the tide. Okay, that's what your focus should be. Okay, and trading on the higher time frame premise, using an intermediate term time frame, your short term day trades and your scalps in that direction also will have very, very immediate feedback. You'll know right away if you're going to be profitable in the trades. You don't get that lackadaisical price action you usually get when you're trading counter trend. Stop loss orders obviously always are going to originate at a 30 pip stop from our entry point, and obviously whatever your entry price is, just take 30 pips from that, above for shorts and below for longs. First profit is always going to be taken at 50% of our position at 30 pips profit. So in other words, once the position goes to 30 pips profit, we take 50% of the position off, and once we get that, our stop loss moves to a break-even status. Okay, so now we're in a risk free scenario. Okay, we've already profited. We got half the position off. So basically we're making 1% on the trade. We're locked at break even. We cannot lose anything. We've already made and booked 1% profit. The remaining balance of the trade, you would look for targets based on Fibonacci extensions, 127 extension and 162 extension. Or I don't have it listed here, but you can have the 200 extension as well. Now you have 50% of your remaining position. There's a couple ways you can handle that. If you are uncomfortable and you're still learning, my advice would be to take 30% off when it gets to 127 extension, and then take 10 more off at 162, and maybe even another final 10% off at the 200 extension. Or take 30 off at 127, take 20 off at 162, and just paper trade the remaining portion. You don't have any open position, but then see if it goes to the 200 extension. Okay. But really the 127 and 162, you want to have at least 70 to 80% of your trade already in profit. And then if you have a small portion, obviously, you can leave that to ride to 200% or even greater. Okay, but you want to be taking profits and book them at 127 and 162 of the swing that you're trading. Okay, let's look at the 10-year T-notes and how we can use these in conjunction with yield analysis. And what we're looking at here is this is March, April of this year in 2012 going into spring. And we have a weekly swing low formed at the 128 big figure for the 10-year T-note. It's the US 10-year T-note. Note also that we have a old low here just above the 127 figure, and we have a rally up to the 132 figure, and then we saw a decline down into March where we had support found at 128 big figure. Now that's an optimal trade entry. Okay, so if we see a swing low on a weekly chart on a 10-year, and we see a pivot or swing low form at a big figure like this, 128, we also see open interest declining. Okay, you can see at the bottom here the purple level here, how open interest was declining. We would expect prices to rally up. Now, if the T-note's rallying up, that means that the yield is going to be dropping. And if again, this is what happened later on going into the year, we saw that spring rally up, seasonally speaking. That is an inverse relationship between the bonds, okay, bond yields. So as the March low was formed and we rallied up into May, June time period, that was going to be mirrored in the yield, okay, dropping. So if the T-note's rallying up, the yield itself is going to be declining, okay? So that's going to be bearish. It's going to drag risk out of the market, okay? In other words, the risk off scenario will unfold. Okay, there will be a flight to quality, and during this time frame, we would see the dollar index rally, and obviously, um, risky assets in foreign currencies and such, they would be declining. Okay, so we have seasonal tendency. We see the support and concepts that we utilize in all of our trading. Optimal trade entry, trading at a key support level. We would expect a rally up in this time frame. Okay, April, May time period going into the June months. Okay, let's see what happens in the 5-year T-note. Same scenario. We see a weekly optimal trade entry trading down at the 122 big figure. We see a swing point low, okay, going into April. What unfolds, obviously, much in the same capacity we saw in the 10-year, the 5-year rallies up into the end of May, early June, okay, and even higher in the case of September of this year. But we saw the shift that takes place with a bullish move going higher in the treasuries and the T-notes. Now, if the futures contract's going higher, again, you got to remember their inverse relationship. That means it's going to see a decline in the yield. So we see dollar up because dollar's going to be trading in pretty much the same direction that the treasuries are going to lead it. Many times the dollar will lead treasuries. Okay, it's vice versa. It's kind of like one follows the other. Okay, but you want to add the seasonal influences in the time of year, like when we trade intraday, we have time of day theory. We have time of year theory, where we see a spring decline or risk off scenario. Okay, and you'll see the dollar increase and bonds rally. So what does that look like in the yields? Okay, what we're looking at is a bond yield triad. And what we're looking at specifically is the 5-year U.S. Treasury T-note, the UK 5-year bond yield, and the German 5-year bond yield. And how I got this chart, I went to Bloomberg.com. And if you go actually and do a Google on 5-year U.S. Treasury government bond yield. Okay, and click on that, and you'll see the Bloomberg link. Do the same thing with a UK 5-year bond yield, Bloomberg. Put that in your Google search, and obviously do the same thing with the German 5-year bond yield, Bloomberg. And when you Google that, you'll get the link for it. Click on it, and when you get the chart that opens up similar to this, you'll just simply add the symbols you see here. For a 5-year U.S. Treasury or T-note yield, it's USGG number 5 YR colon IND. For a UK 5-year bond yield, it's GUK G5 colon IND. And for a German 5-year bond yield, it's GDBR5 colon IND. Now what I want to draw your attention to real quick is if you look at the darker orange color, and I can't pick the colors, it just does it by default. But if you look at how in March, April, okay, the U.S. Treasury was able to make a higher high in yield. Okay, in other words, it would have went lower on the T-note. The green level yield, that's the UK, it was able to make a modestly lower in comparison in terms of the highs made in the US. Then we see the German was also weaker as well. Okay, so it wasn't able to go lower in its futures contract, but the yields, you can see the disparity, the shifting in place that takes place where the U.S. Treasury 5-year went higher. So we have a Smt Divergence, okay? There is a confirmation that there is a weakness underway going into April. So we see that weakness translated in the form of these overlays. If you take the UK off, okay, so now we're just looking at the German 5-year and a US 5-year. You can see a little bit clearer now that the green level, green, is the German, and the orange color is the US. US was able to make a higher high in yield, while the German was unable to make that higher high in going into March, going into April. So we see a slide lower in yield, and that was translated in the rally up in the T-note that we saw in the U.S. Treasury. So there's this symmetry between the two. You want to be watching the yields, you want to be watching the T-note, you want to be watching the German yield with the German futures contract. You can trade the not trade, but you can track it with its futures contract and the UK as well. Seeing these divergence, okay, adds confidence to your expectancy that we should be seeing weaker British pound and fiber prices and a rally in the dollar April-May time period when the spring seasonal influence should be coming underway. Now looking at the US and the UK, you can see that same thing happening. The orange level, that's the US, and the green is the UK 5-year yield. we were unable to make that comparable higher high in the yield in the UK. So we see the SMT divergence that we would expect to see going into April. So we saw further evidence by removing one. You can, it's a little bit clearer. You can see it, divergence between the two yields. And by looking at just simply the UK and German yields, you can see that the German and UK yields were not able to make comparable highs. Between December and the middle of March, the UK was able to trade higher. At the same time, the German was weaker, okay, and was unable to make a higher high in yield. And you've seen that also going into the actual price levels that the fiber itself was trading, because that's what the German's going to be measuring, the yield for that specific country. The UK is for the cable. Well, if you look at the underlying weakness that was in the yield for the German, you can see how we were really, really weak, really soft in the March-April time period for the fiber. So there was really no participation whatsoever or interest in chasing any higher yield there. They were actually selling into that, and you could see the weakness really accelerate going into June and the middle of July. Okay, folks, we're looking at barchart.com. Okay, this is a free website, absolutely zero fees whatsoever. This will give you access to commodities and commitment of traders reports and open interest. When you go to the home page, this is what pops up. You just go over here to this little tab here. It says select a commodity. Tap that, and we'll start with the US dollar index. Okay, when the window opens up, you'll get on the top of the list typically is the cash. You don't want that. Here is the nearby contract, December. Next month out is March, following by June and September. Just click the top contract here, the one that has a month, again not using cash. Click on December. It'll obviously depend upon what time of the year you're trading and looking at the resource. It'll be a different month obviously, but you just want to choose the top one because that's going to be the nearby contract. Then go over to this area here where it says customized chart. Click that tab, and that'll open up a window that gives you a chart like this. Okay, and what you're going to do is you're going to scroll down to this little area down here where you can set the parameters. You want to set the frequency to weekly nearest. What that's going to do is going to give you a chart based on weekly ranges using the nearby contract always. Okay, I'm going to change it to candlesticks. I'm going to change it to 1 year. And make sure this is saying total volume. Okay, total volume. And the reason why you won't get the open interest and volume as you see down here otherwise. Click draw. Okay, and you'll get a window pops up with a new chart here. And what this is a weekly chart using weekly range highs and lows derived from the nearest contract month of the US dollar index. Okay, and if you look at the bottom here, this purple line here that's moving along here, snaking up and down, okay, that delineates the total open interest for the dollar index. And obviously it goes without saying these vertical red and green lines are volume. Okay, we're not going to really pay attention to the volume, but there's just no way for me to take the volume off and just leave the open interest, so we have to kind of look past these vertical lines and pay attention to the purple line in here. Okay, so let's go and scroll down just a little bit. Notice how we rode up in price here on the dollar, and then we went into a consolidation after a small retracement. Okay, see this consolidation in here? We have a range high here, and we have a range low in here. Note the time of the year. Okay, March, April, May. March, April, May. Okay, so that's springtime of this year. Note the low here and the high here and this low. This is optimal trade entry. Pull that up on your platform, pull a fib across that, and you'll see that we did trade right back down to this level here. Now, utilizing this this concept of weekly ranges and seasonal tendencies Okay. Typically in the springtime, we see a weakness come into the marketplace in the form of the British pound usually making a seasonal high, April, May, and trading down into the summer months. Well, that's going to be a mirror image or reverse, okay, in the dollar. The dollar should rally up at that same time frame, and you see that unfolding here. Okay, now we're going to introduce the concept of open interest, okay, and I want you to take a look at this drop, okay, rather sharp drop in open interest right here during a time frame when we're in a consolidation. This is the commercials tipping their hand that this is now no longer going to be staying within this small little time frame of trading range. Okay, they expect higher prices. Why? Because open interest is declining. We've learned that open interest decline in a consolidation is commercials doing what? Lessening their shorts. If they're lessening their short positions, they expect what? Higher prices. And you can see that unfolding here. Okay, now by itself, that's wonderful. But how do you confirm that? How do you see the x-ray view, so to speak, of this open interest uh, indicator giving you the insight that we're supposing it's doing here? Well, you scroll down to this little area on your page and it says Add Study. Click on this tab here, and you're going to go to Commitment of Traders Line Chart. Tap that, then Draw Chart. Okay, now watch. See the open interest declining here? That's lessening of shorts. The red line down here is the commercials. Okay, they are below the zero line here, so because they are net short. But look what they're doing at the same time here. Middle of March going into April, they're really reducing their shorts. See how they're covering their shorts? At the same time frame, open interest is declining while price is in a consolidation, while price is trading at a key support level, 79. See that level over here? 79. So we can expect reasonably, seasonally, we're looking for higher prices in the dollar, weaker in the fiber and cable. Okay, so there should be a risk off scenario. Risk off is going to draw participants into buying safe haven assets. Now, one can argue that the dollar may or may not be a safe asset to most, but for instance, you can see that still unfolding here with a higher dollar rallying up from the April, May timeframe into the summer months. So then we have this mindset that we're looking for bullish prices in here. Okay, we would be in a buy program all through here. Okay, so now let's look and see if we have that same thing occurring in the British pound at the same time frame in this year, in the spring. So let's go back over to the commodity tab, and we're going to go into the British pound. We're going to use the nearby contract, and to click on your customize chart tab, and we're going to do the same thing we did with the dollar. We're going to make sure we are on candlesticks. We're going to look at weekly nearest. We're going to scroll to a 1-year chart, making sure total volume is clicked, and we're going to draw the chart. Okay, now we have a weekly chart on the British pound. Okay, and you can see that April May high unfold here. So we saw price drop down. Okay, so let's add a little bit of time to this because there is a little this is that area right here. Okay, now if one takes this high here down to this low, you can see that this is an optimal trade entry. Okay, this is an area where we would expect implied resistance, also noting that we did take out this old high as well. So price was really it was free to find lower prices because we were seeing higher prices poised in the dollar at the same time frame, April, May. Now also note that we were in a range between this low, okay, and this old high in here. Okay, now we did break out. Okay, we did break out there, but we saw a rapid increase in open interest. Okay, so what does that mean? If the open interest is increasing while within a larger trading range, okay, and one could argue really this is a large trading range here. We had a rapid increase of the open interest here, Gave up just a little bit before this run up, but ultimately we're added right back and above the previous open interest here with short. So they quickly added all those shorts back while we rallied up into a new high higher than this one. But we did not get back to this old high as well. So we traded right back into this range. Okay, so think about what we covered in the webinar inside the range, and that concept is unfolding here. So now watch. We're going to be looking for this open interest or increasing shorts, okay, to be confirmed with what in the net trader's position. Well, if we pull that chart up, we should be seeing what? We should be seeing commercial traders going net short or adding to net short positions. Okay, and we're going to do this by adding a chart here. Okay, so now if we see the open interest increase like this, okay, we would expect to see what in the net traders position chart? We want to see an increase of net short selling or a net short position or a rapid reduction in their net long position. That would confirm this, okay, as commercials themselves doing what? Expecting lower prices. So we go down here to this add study tab, click on that, go to commercial commitment of traders line chart, add that, then draw. Okay, and you can see here we have the chart noted. So we see here, and you can see the red line here. And we're gonna change it to a 1 year so we can see it a little bit clearer. And if by clicking on the 1 year, we'll see that this red line here delineates the commercial activity. Okay, you can see how they rapidly dropped down from net long and net short while the open interest was increasing. So that was a confirmation that we were seeing net short commercial short selling. Okay, so if we see both open interest increasing like this and the red line here delineating commercial traders, okay, they went from net long to net short going into May. Okay, so we saw this rally as a suspect false fake out type of move here, and we just ran out this old high and then obviously rejected it very harshly. Now this was the net short position, okay, held by the commercial traders expecting the top to form in the British pound at a seasonal time frame when the dollar was poised to rally, okay, and seasonally when the British pound was expected to go lower. Okay, so now we've confirmed two sides of the market, the dollar and the British pound. So let's see if we can see some support also in the euro. So we're going to go over to this tab here. We're going to go into the Euro FX tab, and we're going to use the first contract month. Go over to Customize, scroll down, and what we're going to do is make sure we're on candlesticks. We're going to use the weekly nearest, 1 year, making sure total volume is clicked, and we're going to draw the chart, and we will arrive at the euro. Okay, and we have the March April time frame in here. Notice that the fiber was unwilling to make a higher high here. Okay, so we have that divergence, okay, between the pairs. So we have SMT divergence during a seasonal time when we would expect the fiber and cable to decline. We also expect to see the dollar to rally. Okay, so by seeing that, we also note that we have a trading range in here. Okay, the price is trading in a trading range. Okay, so same thing, just inverse relationship between the dollar and the euro. Because remember, we had the same thing happening in the dollar during the spring of this year in 2012. We saw the dollar ranging and then expected to see higher prices because open interest declined and commercial short selling was rapidly reduced, okay, in the dollar. So that's bullish. So we were seeing the same thing, hopefully, in a mirror image on the fiber. We're in a consolidation. Okay, April, May time period. So between this vertical line and this vertical line right in here, okay, we're in a range. Notice we saw open interest increasing. Okay, that's a nice increase of open interest during a time frame in the year when we would expect to see weaker prices. Also, we have an optimal trade entry from this high to this low, traded right up into that at the beginning of April. Okay, so we now have optimal trade entry during a time when we're seasonally weak, when we're expecting firmness in the dollar. Okay, and now let's go and add the commercials by COT and the commitment of traders line chart. Add that. Click draw. Okay, and you can see here we had the reduction. Okay, in other words, we had open interest increasing here, while we also saw the commercials in this case actually adding a little bit of their net longs in here. Okay, they were already net long above the zero line here, so they were all along here basically trying to catch this low here. So they were buying all this decline from this high down lower. So when price started to whip lower below this low here, at that very moment between April and May, there was really no increase of selling. In fact, they were actually buying more of it in here. Okay, so it's in this example, it acts much like the SMT, where we have the confirmation in the cable and the dollar, but on the COT, we don't really see it here. Okay, we've been maintaining a very large net long position on the commercials. Let's go and pull up 3 years of that and you'll see what I mean. You can see that we've had a net long position by the commercials for a very long time, and while we did drop down in here, there was no real indication that there was additional short selling here. Okay, they were lessening their longs here going into April, so that's the insight you glean, not necessarily this one here. So we did lose some net longs here, so we have confirmation in that regard, but between April and May, there was nothing to indicate the movement was confirmed between commercials and open interest at that particular moment. But if you look at this scale that we have here on the 3-year, you see how we had open interest increasing in here. We had open interest increasing in here while we saw a reduction of the longs. So that's more or less essentially the same thing. They're lessening their longs, okay, which is increasing their short positions, while open interest increased in here while we're in this range. Okay, so that was the catalyst for confirmation on the higher time frame. So while they didn't exactly line up between cable and fiber, both of them more or less had the indication going in. So fiber was giving it up here early, and as you can see, it's also supported with the fact that they were unable to make a higher high here in April when the cable was able to do that. All right, so that's one way of applying open interest, looking for the reduction and increasing of open interest for measuring smart money in the form of commercial traders and using the COT graph. And now we had this stage set for weaker prices in the spring of 2012. So now we have more or less the large macro view, okay, couple that with the interest rate market now. Okay, so now we have the COT open interest supporting the notion that the seasonal tendency for weaker cable and fiber and higher dollar in the spring, we see that also supporting the interest rate insights that we've already looked at. And now we have a sell program, okay, in place. Now we can look for shorts. We can start selling, okay, for a short position going into the summer months. Okay, we're looking at the dollar index. This is a daily chart, and we're zoomed into the April month of 2012, and we're looking at this, again, seasonal tendency for the market to decline on the British pound and usually be a risk off scenario. And obviously we'd be looking for a reverse scenario, which would be bullish for the US dollar. And we noted already this swing here This is optimal trade entry in here where price would have been rallying from, or we would expect to see it rally from, and the sweet spot comes in at 178.85. So this would be a catalyst for upside momentum for the dollar, looking for this old high and this old high as upside objectives. At the same time that this is occurring, we expect to see weakness in the stock indices to anticipate a risk-off scenario. We saw the Dow this year in April make a very modestly higher high here, and this little rectangle is delineating the month of April as well. So we see a modestly higher high here, but let's look at the daily on the S&P at the same time frame. We have a lower high. Okay, see that? Now we already have a Smt divergence between the stock indices, and obviously the Nasdaq Composite Index also that same month was able to post a lower high. Okay, so we have Smt divergence indicating that we have underlying weakness. Okay, in other words, as this rally up into April, May time period, stock averages were not able to confirm one another. So Dow Theory suggests that there's probably waning momentum, and don't be so aggressive in terms of buying because you may be seeing a withdrawal or a retracement lower. Let's go back to the dollar. Okay, and let's look at what happened from that point. Okay, you can see obviously the dollar itself rallied on up from this high and this low here, this range. Okay, if we look at just that, we can get some upside objectives for the dollar. Okay, and what we're doing is we're looking for obviously objectives, looking for potential areas where price may shoot to. Here's the 162 extension and a 200 extension here. Okay, now once price broke above this high, this swing, okay, is fine. You can still use those targets, but we got to go to the left side of the chart and look at the larger magnitude price swing that we're working within. So this high to this low. So we would use our fib tool from that high and pull it down to the lowest low in that fractal. Okay, so we have this high down to this low, and we will be looking for the 127 extension for upside objectives here, and 162 extension, which nails the high here. And moving forward, you can see the dollar had slipped off precipitously from that point. Now you can see hopefully here the value of using a higher macro view analysis approach to your trading. And if you see this type of event unfolding in the dollar, the same thing should be happening in the reverse, okay, on the downside on your other asset classes. And let's look at the daily on the Dow Jones. We saw price obviously slip lower as well, okay, confirming that upward momentum in the dollar. The S&P 500 also broke down and slipped lower. And the Nasdaq Composite, not surprising, slipped lower as well. Now let's look at the fiber. Okay, and what I have here is the April month delineated between the two red vertical lines. Okay, and we're looking at the fact that we were unable to make a higher high here. Okay, and just for a second, let's just shoot over to the cable, and you can see how in that same time frame in the month of April, the cable was willing and able to make a higher high. Okay, so let's go back to the fiber for a second. This market absolutely posted weaker technicals across the board. In other words, between the two pairs, fiber and cable, because they're so closely correlated, they usually trade in sympathy. But as you can see here, the Smt divergence, correlated pair Smt divergence, was showing that there was absolutely no interest whatsoever going long in the fiber. And if you recall back in when I was doing reviews, we were talking about this market being the weaker of the sisters all during this particular time frame. And this is really the catalyst for my viewpoints. And while I was saying it real time in advance before the markets were trading, we were looking for this old low to be traded to back in here. Okay, so, and also back here as well. Now this high and this high here, notice that we were lower here. Okay, so we have February's high and April's high lower in the fiber. Let's go over to the cable. Notice we were going higher in the cable. Here's February's high and April's high. So we were posting higher highs in the cable. This was the relatively stronger of the two pairs. So when there was a buying opportunity, we could be buying in here, okay, and be more confident that the market's going to be more favorable for us as a bull if we're a short-term trader, but we're focusing on the higher time frame, intermediate term basis. So we're looking for what? The sell scenario, and that being the case with the fiber. Okay, so you could look to sell this market here going into your seasonal time frame from this high down to the low. You can see we have optimal trade entry in here, and price did slide off. The cable at that same time frame, we had a larger price swing from this high down to this low that the cable was retracing in. Okay, so let's pull that up. You can see here's the sweet spot. Okay, here's that 70.5 fib level. Price went right to that level, exactly to that level. Okay, and I posted a market review and a daily review suggesting that I would be shorting at 163, a break above 163 figure. Okay, so if you go back to that time frame and look at the videos, you'll actually see me talk about being short here. And this is the reason why. We're within that April time period for seasonally expecting a decline. Okay, we went up into a higher time frame implied resistance level. We're at a figure 163. Okay, so even though we were bullish compared to the fiber comparably, we are still within a time frame where the price itself should be running out of steam. And when we get to these levels like this, so far deep into a retracement of these price swings, you got to expect some weakness. So now let's look at what's happening here also. We have the high at April and the high at May, higher in the cable. Let's go back to the dollar. Look what's happening here. We have lower, albeit not by much, we have a lower low here than here. Okay, so the dollar was lower. The cable confirms it, higher. But let's go back to the fiber. See this? There's a USDX Smt Divergence. Okay, so this tells you that you have a very, very large price swing possibly unfolding going forward. This tells you that it's going to be bearish for the fiber. Okay, and since tandem trading occurs in cable and fiber generally, and you're looking for higher prices in the dollar, you, you can get yourself in sync with a very, very handsome intermediate term short. And looking at this high here, down to this low, in here is a sweet spot, and price went right up to that point by the pip and then fell out of bed. And let's look at what happened here. Price does in fact trade down below this low, in fact. Small little minor bounce in here, and then finally broke through. Okay, and eventually even traded even lower than that. If you'll use the Fibonacci concept that we talked about for this plan, we look for 127 extensions, 162 extensions, and the 200 extension. This price swing is what we're going to use going lower. Okay, so if you use this low up to this high, once market structure breaks this low here, you're going to be looking for the 127 extension, which it finds here handsomely and bounces, and looking even gives you another optimal trade entry to get short. Okay, and this is, we're jumping ahead really, this is the short-term trading part of the series, but price does give it a correction here, trades right up into old support broken, now resistance, falls out of bed and goes what? 162 extension. And then obviously price had snapped away from that rather handsomely. So getting short here on the notion that we are entering into the seasonal time period and looking for Smt divergence is one avenue here that you could have got short. If you missed this one, this was the other opportunity to get short, okay, and ride it lower. That rather handsome price swing. If you look at what transpired just from the original high here in April down to the 162 extension, that's 1,230 pips, okay? And if you got the second entry in here using the 1st of May area, it's a 1150, 1,150 pips, okay? So not bad in terms of you know, pip hauls. Takes a little bit of time to get these guys. It doesn't happen overnight, but you got to really hold on to it and just have a lot of patience with them unfolding. If you look at the cable, once price gets up into this inside the range concept, the sweet spot 163 is a big figure as well. We are still within the April seasonal decline time period. We have USDX SMT, we have correlated pair SMT, weaker highs comparable to the higher high in the cable here. So now what's going on in the lower time frame? Okay, let's just use a hourly chart. Okay, here's what's happening. Price trades up into that 163 figure, trades off. Okay, now as price trades lower like that, okay, it comes down into that 62% level here on a higher time frame price swing, finds a little bit short-term support level, eventually breaks down below it, and look, it comes right back up to that same level here again. See what it does here? Runs into it as resistance and then slides away. Again, aggressive move lower. Okay, now let's add to this the day separators. Okay, now if you missed just shorting straight up into the 163 figure, okay, you have a short-term high here. We have a higher high here, lower high here, and a lower high here. So this is a daily swing point. This high, this lower low, I'm sorry, lower high and lower high here. Okay, so we do have swing point here. So now we could be looking to get short beyond that point in here. Okay, you can use optimal trade entries. You can use reflections, anything that you use to trade on your pattern, that's what you start hunting. Okay, and we also have a higher price swing point on the weekly basis. Okay, see these double lines here and here and here. We have the high of that week, so between this double set and this double set, the high is here. Then we have the high here between these two, and then we have the high here between this set and this set. So what is that? That is a weekly swing high. So we have the high, and lower high. Pull that up on your own weekly chart and you'll see what I'm referring to. Now, when you have that also, okay, that's when you have the acceleration in the price movement much, much more aggressively moving lower, okay? And when we see the high and lower high here on the new week, okay, going into Monday and Tuesday, using the how to capture explosive profits in the Forex concept we used in that video, you're looking for Monday to Tuesdays London Open to present you the high of the week. This is where this takes place. We have Sunday's trading, Monday runs up, okay, and it makes the high on Monday and then trades off. Now, if you miss that, that's fine. Don't chase price. You don't need to worry about rushing into it. Once you have now a daily and a weekly swing high, you can use the high down to this low here, and look what you have. You have the 79-cent retracement level laying directly on top of this higher time frame fib level that we just drew off the daily. Okay, that's the 62% retracement level on the daily, and now we have overlapping fibs on a 1 hour chart conversion right there for a optimal trade entry. This is a nice sucker rally. It gets everybody excited chasing it, but this time of day is New York Open. So you could be selling in New York Open to get in sync with the higher time frame and then ride it lower. Okay, and positioned there, you can see rather handsome declines, and these are the moves that you want to hold on to during an immediate term price swing. 4-hour chart, and this is that opportunity for a seasonal decline in April here, and this is that lower high going into the beginning of April. If you use the high here and price trades down, if you look at the high here, pull it down to that low, you see how price goes right after this 9-cent tracing level and stays there for a little bit and then finally breaks down. Okay. Notice also that we have smaller optimal trade entries in that same area, and you have it here as well. Here, this high, low, and here, and it breaks down. See, this is why you have to understand how price can be fractal. Okay, it's not a hard concept to learn if you spend some time with it, but you have to definitely go through higher time frame charts and start breaking them down and looking at specific turning points. The absolute seasonal month that we're highlighting here is if you look at the high here to this low, okay, and the reason why I'm pulling this is these are the highest high amongst all these candles, and this is the lowest low amongst all these candles. Okay, price goes right back up to the sweet spot, which is an overlapping of this higher time frame fib level and here. Okay, so you can see how that converges. So you can get short in here on even the 132.50 level would have been a nice opportunity to get short here and going much lower. So again, much in the same vein that we've shown with the cable, you can see how price did fall rather handsomely in the fiber. And again, here's that bounce at an old low, came up and gave you another optimal trade entry in here. And we'll just draw that in here real quick just for the sake of completion. And set a nice tracement level in here. And you go down to a 5-minute chart, you can actually see optimal trade entry in here on this small little minor price swing. So again, another fractal pattern within a higher time frame fractal that's broken down to a smaller fractal, which is what we're showing here. So even looking at how price breaks down from these larger intermediate term price swings and then the 162 extension, look how it doesn't give you much in terms of movement below that before it snaps away. Okay, now if you held on to it and it breaks this high here, once price runs above that, you have now a break or a market structure shift. Okay, so you don't want to just collapse the trade there. You want to wait for it to try to retest and get back down to these lows. And by using another optimal trade entry, okay, you can see a better place to cover your short instead of getting out here and panicking. You can get out down here at the 162 extension, and then obviously price starts to move away from that. Okay, so that's what looked at you in April, staring you right in the mug. Okay, for long-term, intermediate-term price swings. And if you look at how the tools on a macro view really help you get in sync with these trends, you're just going to use the simple short-term analysis concepts to get you in the trades. Judas swings, intraday optimal trade entries, using the weekly concept of looking for the weekly high, Monday to Tuesday's London Open, and or the very latest Wednesday's London Open. And if you're in bullish environments, you would use the weekly Monday, Tuesday London Open for the low of the week to form, and or the latest Wednesday's London Open to capture the weekly low, and then get in sync with that and try to hold on to these things as long as you possibly can. It's very difficult if you're always just looking at every minor price swing in the market while you're in these. That's why it's much better if you're going to have this concept in trading and still do short-term trading. You need to have separate accounts, obviously, but you just put the trade on and let the stops stay outside of potential striking distance. And by that I mean, if you get short in here, you let it run down for a while before you do anything with trailing stop losses inside of it, because price can come back and tag you, and then you'll miss all this. Okay, so you want to look for support levels to be broken like it does here, and then comes back and retests it and trades lower. Then move your stop into a profitable area where you can lock in a very small portion of the profit, and then don't chase it. Don't trail it down too tight. Learn to scale out profits going down at the reasonable predetermined 127, 162, and 200 extensions. The fib levels for the cable, again from this high up here, this price swing here, okay, this price swing here is the second leg of this move here. So we have to use this price swing before we would ever use this one or this one. Okay, so with that concept, let's take a look at the lowest low candle here and to that high. Okay, and here is the 127 extension, and here's the 162 extension, and then here's the 200 extension here. Okay, you can see how price came down. Didn't get to this old low, but it did get to 200. So you could have scaled off, obviously, 50% of the position once you get half profit. I'm sorry, 30 pips, move to break even, and then look for your 127 extension. Now you could take 30% off of the total position, okay, or you could take 10, 20 at 62, and then leave the remaining portion to reach for 200, or you could just take the remaining 50%, divide it by 30 of the original position, take it off at 127, and then the remaining 20% would be off at 162 extension and not reach for the 200. Or you could just go for broke, and once it takes 127 out and starts reaching for 162, trail your stop down to the 127 for the remaining portion. So you can, if it comes back up, at least you're going to get out with your remaining half at a nice logical area to take profits. And if it gets down to 162, take half of it there off, and have the remaining 25% reach for the 200, and then show your stop just above the 162 extension. Okay, but there's a lot of different ways, and I'm trying not to give you a very clear black and white way of doing it, because I want you to have some input on your own. There's a lot of freestyling you can do with these using the analysis concepts, and again, hopefully this has just been providing you an example on how to intermediate term swing trade, and using the higher time frame macro reviews to get in sync with the market and learn to anticipate price moves, and then using the smaller time frame concepts we've used in the other videos to help you with your timing and such, and those being the optimal trade entry video, the high probability price patterns video, and obviously you need to be cognizant of the risk and equity management. So those videos, they're very insightful and applicable, obviously, for this this tutorial. So I'm going to close it here, and hopefully this has been insightful to you guys. And if you have any questions, obviously, just post them on the forums at babypips.com. And until then, I wish you good luck and good trading.